Every risk manager's nightmare is simple. One invisible player quietly borrows chips from every table in the casino, then flips the whole house with a single bad hand. In March 2021, that player had a name, Archegos. Not a bank, not a hedge fund, not a public company, a family office, private, quiet, supposedly safer. And yet when it imploded, the blast wave tore through global banks, pension funds, and index investors who had never even heard the word before breakfast. If a private investor can cause public damage without telling the public anything, what exactly is the system protecting? This is where money, power, and history collide, and nothing is as simple as it looks. Archegos wasn't a freak accident. It was a feature colliding with a loophole, a structure designed for privacy, weaponized with leverage, then wired into the public markets through the very intermediaries meant to safeguard them. The lesson isn't just that one office blew up. It is that a private balance sheet can build a public time bomb if disclosures are optional and the leverage is synthetic. To see how a single office shook the world, we have to start with what a family office really is, and what it is not. Once upon a time, family office meant a small team managing a fortune earned over generations. Low drama, long horizon, tax efficiency, stewardship. Think art collections, charitable foundations, municipal bonds. Safe, boring. Modern finance rewrote that fairy tale. Today, a family office can be a shapeshifter, part private wealth manager, part hedge fund, part venture shop, often with fewer disclosure obligations than either. No outside investors means no fund prospectus to file. No public shares means no quarterly earnings call. In regulatory terms, they're private advisors, and that privacy is the point. You can be massive and still be invisible. Archegos fit that mold. A family office managing the fortune of one man, chasing returns across a handful of liquid high beta stocks. No investor letters to leak. No public risk factors to debate. No position reports listing holdings quarter after quarter. In a marketplace that worships transparency, family offices live behind the curtain. Privacy itself isn't a crime, but pair privacy with modern leverage and privacy becomes opacity. Opacity becomes risk, and concentrated hidden risk eventually becomes everyone's problem. Here's the trick you need to understand. Total return swaps. Imagine wanting exposure to a stock, call it Company X, but not wanting to own Company X. You go to a prime broker and strike a deal. Give me the total return of X, price gains and dividends. Over time, I'll pay you a financing rate. If X rises, you pay me the gains while I pay your fee. If X falls, I owe you the loss. On paper, the bank owns the shares. In reality, you carry the risk. That's the ghost position. You control the economic exposure without the legal ownership. And because you don't technically own the shares, many disclosure rules don't see you. You're not on the shareholder register. You're not in the filings. You are everywhere in the market and nowhere in the paperwork. Archegos used these swaps with multiple banks, each one booking its own piece of exposure, each one marking against its own models and risk limits. Credit desks saw a client that looked manageable relative to collateral posted and prices observed. But no single bank saw the whole pie. That wasn't a mistake. It was the system's default. Fragmented views, siloed risk. Everybody thinks they're lending a tall, skinny ladder until they discover they all lent the same ladder to the same climber on the same stormy night. Leverage made the ghost louder. $1 of collateral could control multiple dollars of exposure through swaps. Rising prices made margin calls look remote, so limits drifted and complacency hardened into policy. Models assumed independence. Reality delivered correlation. Markets run on a simple bargain. Take risk if you want, but tell the market enough to price that risk. For equity managers, and that usually means periodic filings listing big positions. But the bargain has a blind spot. If you're a family office and you use derivatives like swaps, much of that disclosure doesn't apply. Legally neat, systemically messy. It's the difference between a smoke detector and a closed door. Regulators and counterparts heard the alarm in the distance. Position sizes were growing. A handful of stocks were moving in suspicious sync. But they couldn't see the fire load behind the door. And because the exposure sat as an overlay on the bank's balance sheets, it also sat inside index funds that owned those same names, inside pension portfolios, tracking those indices inside anyone whose passive capital had been poured into the public market. The words private office meant public relations. The swaps did the engineering. Put them together, and you get a public facade with a private basement, sturdy on the surface, hollow underneath. Every leverage story pivots on the same hinge, a down move that shouldn't T-matter until it matters. Prices wobble. Margin calls feed selling. Selling pushes prices lower. Lower prices trigger more margin calls. The loop tightens. For Archegos, the hinge was a stumble across media and tech names that had climbed on momentum and concentrated buying. A few downgrades, a missed narrative beat, a sour day in the tape. Prime brokers called for more collateral. The office had to sell to raise cash, but selling the names it was most exposed to drive those names down further, inviting fresh calls. That's the doom loop, a margin spiral that turns arithmetic into gravity. Behind the scenes, brokers faced a prisoner's dilemma. Coordinate a managed unwind and share the pain, or rush to the exits with pre-market block trades and try to exit whole while others eat the loss. You know how this game ends. In a crunch, the last one out pays the bill. Pre-dawn, the blocks hit the tape. Whole swaths of stock prices collapsed in hours as banks dumped inventory to de-risk. It was loud, messy, merciless. The invisible became unbelievably visible on every price chart and every portfolio statement. Who paid? Family Office suggests the risk is personal, but the losses were socialized through the plumbing. Prime brokers took direct hits. Risk desks that trusted models discovered correlation the hard way and wrote down billions. Shareholders of those banks, including retirement funds and index investors, ate the drawdown. Passive holders of the affected stocks watched their portfolios gap lower, not because the companies suddenly earned less, but because a hidden whale was surfacing and gasping for air. Liquidity providers widened spreads and demanded more collateral system-wide, raising the cost of capital for everyone temporarily. There were no bailouts, no taxpayer checks, and yet public capital took the punch. That is the phrase we need to sit with: public damage. The costs diffused across shareholders, savers, and funds who never consented to be counterparties to a private strategy. Markets are risky, people shrug. True, but risk that can't be seen can't be priced. When the rules say this is private, and the reality says this shapes the public tape, something is misaligned. None of this is new. Archegos wasn't the first time hidden leverage metastasized into systemic pain. The names change, the anatomy doesn't. Long-term capital management in 1998, Nobel laureates, market-neutral spreads, funding in the repo markets. Individually prudent bets became collectively lethal when correlations converged. The unwind threatened the banks because everyone was the other side of the same low-risk trade. Amaranth in 2006, natural gas spreads, big directional exposure through derivatives. When the weather didn't cooperate, the margin math crushed them and counterparties scrambled to contain the damage. Archegos in 2021, equity concentration via swaps, no outside investors, no public filings, the same old leverage loop. Private model, public exposure, through dealer balance sheets, correlated unwind, socialized pain. History doesn't repeat, it rhymes in the footnotes. How did we end up with a structure that allows a private office to build a public-scale risk position? Two comforting stories. First, sophisticated investors don't need the same rules. If you're managing your own money, the theory says you can fend for yourself. No prospectus, no retail marketing, no training wheels. That ain't fine until the way you express your view pipes your risk into the public markets through systemically important intermediaries. Your sophistication becomes someone else's volatility. Second, derivatives transfer risk to those who can bear it. Swaps let banks hedge, net, and lay off exposures. In calm seas, that's true. In squalls, hedges fail, models buckle, and those who can bear it turns out to be shareholders who didn't know they were bearing anything at all. Neither story is malicious. Both are incomplete. And when incomplete stories meet complete leverage, they end in headlines and emergency meetings. After every blow-up, the same triad arrives: rules, models, and memory. Rules: proposals to tighten disclosure around swap exposures, expand reporting for large concentrated positions, and revisit whether family offices above a threshold should file position reports. Rules matter. But rules are written in ink, creativity is written in pencil. The game evolves. Models, prime brokers revise margin frameworks, add stress tests for concentration and correlation, demand more collateral earlier. That helps until the next decade invents a new asset class, a new wrapper, a new correlation regime. Memory. For a few years, the market remembers. Then performance pressure returns, spreads compress, risk creeps. Career half-lives are shorter than credit cycles. Memory fades. That isn't cynicism. It's the business cycle's heartbeat. Archegos didn't trigger a banking crisis, but it did put a price tag on opacity, and that price is always paid in the future by people who done get a vote in the present. Let's stop hand-waving and draw the causal chain. First, concentration. A private actor builds big, correlated positions in a handful of names. Second, opacity. Positions are expressed via swaps, so public filings don't reveal the economic exposure. Third, intermediation. Multiple prime brokers provide leverage, none seeing the full picture. Each thinks its loan is money good. Fourth, shock. A negative catalyst hits one or more names. Fifth, margin spiral. Calls for collateral force selling. Selling moves prices. Prices force more calls. Sixth, dealer unwind. Brokers dump block trades to de-risk, crushing prices further. Seventh, public transmission. Banks' shareholders absorb losses. Index investors wear the volatility. Passive capital eats the tail risk. Eighth, after the fact transparency, only once the rubble stops moving do we learn what the exposure really was. That is the public damage pathway. And it is not confined to equities. The same architecture exists in credit derivatives, commodities, FX, and the newest frontier, private credit packaged as safe yield with repo financing attached. So what actually protects you? Start by respecting opacity premiums. If you can't see the holder base or the leverage stack in a name, assume the price can move farther and faster than your model. Diversify your diversifiers. When leverage is synthetic, correlations snap to 1. True diversification lives outside the same dealer pipes across asset classes, custodians, and even geographies. Beware the pretty story. Private, sophisticated, hedged. Sound safe until you map the counterparty chains. Ask where the loss goes when the model breaks. Trace it twice. Hold cash optionality. Crashes transfer assets from the leveraged impatient to the liquid patient. Optionality is a position, not an absence of conviction. And don't outsource skepticism. Indexing is powerful, but it is also a conveyor belt. When the machine dumps inventory for balance sheet reasons, it will dump yours too. None of these make you invincible. They make you aware. Awareness is the difference between being surprised by someone else, which is margin call, and being prepared to exploit it. Now peel back the numbers and you meet the human factor. We can talk about VAR limits and stress scenarios forever, but blowups aren't born in spreadsheets. They're born in boardrooms and on trading floors where incentives whisper louder than warnings. For the private office, when a strategy works, the temptation is to scale what works, not ask what breaks it. For the prime broker, in a competitive market, the first bank to tighten terms loses the client. The last bank to tighten terms loses the money. For listed companies, a single sponsor quietly buying creates a tailwind that looks like fundamental demand until it isn't. That's why history keeps delivering the same lesson in new wrappers. We're not irrational, we're human. And humans discount tail risks they cannot see, especially when today's fees and bonuses look certain and tomorrow's crash looks hypothetical. There's a deeper truth. Private rights, public roads. Finance loves to talk about private capital. Fair enough. But all private capital drives on public roads, exchange plumbing, indexation flows, bank balance sheets backstopped, if not by explicit guarantees, then by the social expectation that we keep the pipes open. When a private vehicle loses control on a public road, the damage isn't confined to the driver. The guardrails bend, the lanes close, traffic backs up for miles. We all slow down. We all pay. That's the Archegos parable. Not a scandal about one office, but a reminder about the road we share. If we want private freedom, we owe public guardrails that match modern speed. If we want innovation, we owe transparency, where private risk becomes public exposure. Think of the mechanism again, but picture it like a city map at night. In the dark, you see isolated windows lit in different towers, each bank's view of its own swap book. None of those windows reveal the whole skyline, but they all reflect the same storm front moving in. A gust shakes one building, then a second, then the streetlights flicker. One trader calls another before dawn. We're moving blocks. Across the city, lights erupt as phones buzz, margin calls ping, collateral teams scramble, and the traffic of money jerks to a halt in the places where it's needed most. The public only sees the power flicker. Stock prices gapping, spreads widening, indices lurching. But that flicker tells you everything about the wiring. Private rooms, public grid. Consider the language we use. Synthetic exposure. Economic ownership. These phrases sound bloodless, almost hygienic. They are anything but. Synthetic doesn't mean imaginary, it means engineered. Ownership isn't just a certificate, it has a claim on cash flows, and the obligation to make good when the tape runs against you. When those obligations are layered across multiple banks, each confident in its slice, the system isn't diversified, it is duplicated. Redundancy masquerades as safety, but when the common factor moves, redundancy converts into resonance. The same note, struck in different rooms, becomes a chorus, and that chorus can shake a building. There's a temptation to hunt for villains. Who was reckless? Who was asleep? Who broke which rule? Accountability matters, but focusing on personalities misses the structural point. Systems produce outcomes consistent with their incentives. If the rules allow a private actor to hide a public-scale exposure, some actor will do it. If prime brokers are paid to win clients and grow balances, they will lean into relationships that look profitable in a bull market. If disclosure rules see legal ownership rather than economic risk, engineers will route their positions through instruments that pass the legal test while failing the systemic one. If passive money buys what's in the index, it will absorb whatever the index happens to hold, because that is what passive means. None of this is conspiratorial. It is ordinary. And that ordinariness is the risk. So where do we go from here? Not to prohibition. The tools are powerful for a reason. Swaps hedge, finance, and connect markets. Family offices fund startups, provide patient capital, and pursue strategies that don't fit the mutual fund mold. Complexity isn't evil. It just deserves a price and a light. That means aligning disclosure with risk, not just with form. When economic exposure crosses a threshold, the market should not need a scandal to learn about it. When concentration creates fragility, counterparties should not need a blow-up to see it. Like when the story is private money, the map should still show the public road. If the ending isn't dramatic, and that's the problem. After the smoke clears, the banks rebuild their books. The companies that rode a private sponsor's buying pressure normalized. The family office is gone. The headlines fade. The market returns to earning basis points the hard way. But sediment remains. New juniors on trading desks learn a cautionary tale. Legal teams add clauses. Risk committees insert a slide labeled Archegos. And somewhere, quietly, a different office begins to scale a different strategy with a different instrument in a different corner of the market, confident it has learned the lessons and certain it has not repeated the mistakes. It will be right until it isn't. Archegos wasn't a monster hiding under the bed. A family office used legal tools to build economic ownership without declaring ownership, and when the music stopped, the bill landed in places that never ordered the song. So the next time you hear family office, don't picture a quiet room with framed paintings. Picture a control room with bright screens, wired into half a dozen banks, steering exposure through instruments that live on dealer balance sheets and die on your index statement. The goal isn't to ban the tools, it's to align the stories we tell about privacy, sophistication, and who bears the loss with the world we actually inhabit. Because debt and derivatives don't disappear when you close your eyes. They migrate to the balance sheet that still has a pulse. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.